In the quarter ended December 31st, 2025, Supermicro Computer reported revenue of $12.7 billion, representing a 123.4% increase compared to the same period 1 year earlier. While the headline growth is substantial, the underlying composition of that revenue requires closer examination. Revenue alone is a surface-level metric. The durability and quality of that revenue define the broader investment narrative. Net income for the quarter was $400 million on $12.7 billion in sales, translating to a net margin of 3.2%. Notably, a single customer accounted for 62.6% of total revenue during the period. This concentration raises a fundamental question: whether the company is establishing a sustainable competitive position or effectively acquiring market share that may not be defensible over time. Supermicro operates within the AI infrastructure ecosystem, specifically building server racks that power artificial intelligence workloads. As hyperscale companies such as Microsoft, Google, and Meta expand their data center capacity, Supermicro serves as one of a limited number of providers capable of assembling systems at scale. Its revenue is generated across three primary segments: AI and GPU server systems, enterprise storage solutions, and subsystems including chassis, power supplies, and related components. The majority of current growth is driven by Nvidia-powered AI server systems. A key competitive advantage lies in the company's building block solutions, which enable faster customization and deployment of server configurations compared to competitors such as Dell and Hewlett-Packard Enterprise. Additionally, its liquid cooling technology captures 98% of generated heat, a critical capability for supporting next-generation Nvidia Blackwell chips. Switching away from Supermicro's infrastructure would require a full redesign of rack-scale deployments, resulting in significant switching costs. However, this operational strength is closely tied to its relationship with Nvidia, which serves as a foundational dependency for the business. Recent developments have introduced complexity into that relationship. If there are structural issues within the business, they are reflected in the financial data. 4 key risk indicators emerge, each escalating in significance. First, customer concentration remains exceptionally high. One customer represented 62.6% of total revenue, and 71.6% of the company's $11 billion in accounts receivable is owed by that same single customer. The absence of disclosure regarding this customer limits visibility into future revenue stability. Any disruption, whether through delayed orders, reduced demand, or supplier switching, could materially impact financial performance. Second, balance sheet changes over a 6-month period highlight significant shifts in working capital. Accounts receivable increased from $2.2 billion to $11 billion. Inventories more than doubled from $4.7 billion to $10.6 billion, indicating a substantial buildup of unshipped products. Accounts payable rose from $1.3 billion to $13.8 billion, suggesting extended payment timelines to suppliers. Despite generating $569 million in net income over the past 6 months, operating cash flow was negative $941 million, indicating a divergence between reported earnings and actual cash generation. Third, governance and legal concerns have intensified. On March 19, 2026, the Department of Justice indicted 3 individuals associated with Supermicro. Among them was Wally Liao, co-founder, senior vice president, and board member charged with conspiring to violate U.S. export control laws. The alleged scheme involved $2.5 billion in Nvidia servers diverted to China through shell entities, falsified documentation, and altered serial numbers. Following the announcement, the stock declined 33% in a single trading session. Liao resigned from the board the following day, and a class action lawsuit was filed shortly thereafter, alleging failure to disclose export control violations. Additional reporting identified purchases of Supermicro servers by 4 Chinese universities, including 2 linked to military research activities associated with the People's Liberation Army during 2025 and 2026. These transactions occurred during the period when the broader narrative was already under scrutiny. While Supermicro itself has not been named as a defendant in the DOJ case, the individual charged previously led global business development. Fourth, concerns regarding financial oversight have precedent. In October 2024, Ernst & Young resigned as Supermicro's auditor, stating it was unwilling to be associated with the company's financial statements. This marked the first audit engagement between EY and Supermicro, which was terminated prior to completion. Despite these risks, there are counterbalancing factors that support the bullish perspective. Revenue growth remains significant, with reported in a single quarter and full-year guidance raised to $40 billion. The company's technological differentiation, particularly in modular server design and liquid cooling, positions it competitively within the AI infrastructure market. These capabilities are essential for supporting next-generation Nvidia Blackwell and Rubin GPUs, and competitors have not demonstrated equivalent deployment speed at scale. From a governance standpoint, the company has taken corrective steps. Following scrutiny initiated in 2024, an independent special committee found no evidence of fraud or misconduct. BDO was appointed as the new auditor, and previously delayed annual reports were filed. The earlier governance concerns were formally addressed. Macro-level demand further reinforces the opportunity. Hyperscale technology companies are projected to spend approximately $700 billion on AI infrastructure in 2026. Microsoft, Meta, Google, and Amazon are all expanding GPU clusters simultaneously, creating sustained demand for high-performance server solutions. Supermicro remains one of a limited number of providers capable of meeting this scale requirement. Sell-side perspectives reflect this balance between opportunity and risk. 15 analysts currently cover the company, with a consensus rating of hold and a median price target of $35. Citigroup reduced its target from $39 to $25 following the DOJ indictment, citing elevated reputational risk. Goldman Sachs maintains a sell rating, highlighting uncertainty around margin expansion and competitive pressures. Barclays maintained an equal weight rating while lowering its target from $43 to $38, noting that profitability underperformed expectations despite strong revenue growth. Across these views, the consistent theme is clear. Demand remains intact, but execution and governance risks have increased.